Alright, in this video, we'll be discussing about how the momentum behind the US economy's growth may be slowing down and looking at the recent GDP data that has been released and what it means. Now, just last week, the GDP data for the fourth quarter of 2025 was released by the Bureau of Economic Analysis, coming at 1.4% real GDP growth. This was considerably below the forecast of 3%, which was already at a lower level than the Q3 data because of the cut in government spending due to the government shutdown. But the data came in at even less than half of the forecast expectations. But first, let's quickly go over what GDP even means and how it's calculated. The GDP is essentially all the goods and services produced within a country. And to calculate it, we take into account how much money people spend, mean the consumer spending, how much money businesses spend on buying capital goods such as factories, machines, and inventories. Government spending includes the salaries of the workers and investments such as those into education, healthcare, and defense. The net exports means that's the import that is subtracted from the exports as inputs themselves when not produced within the country. So the 1.4% real GDP growth in Q4 takes all these factors into account and then accounts for inflation as well, which is why the term real GDP is being used. Clearly, the bulk of Q4 GDP growth came from consumer spending, with investment being the second biggest contributor, contributing less than half of the growth of consumer spending, meaning that this growth is currently extremely concentrated. Now, if you look at the previous quarter's data, a trend can be observed. Throughout 2024, the GDP growth kept falling and eventually went negative at the beginning of last year before again rebounding back up again. This can be partly explained by the effective federal funds rate, the EFFR, which is essentially the interest rate at which banks can borrow money from the government, the Federal Reserve, which is the central bank of the US. It is this rate that largely decides at what interest rate loans are then given out to consumers and businesses. A higher Fed funds rate means higher interest rate loans, resulting in lower economic growth and activity. This is why there was a decline in growth throughout 2024 as the Fed funds rate was high, staying between 5.25 and 5.5% until September, after which the rate was cut multiple times. Now, even though the rates were cut in 2024, there was still a decline in real GDP in Q1 of 2025, which could be explained by a few reasons. First, being that it simply took time for the economy to rebound, and this can be explained by the next quarter's data, Q2, where a massive jump took place in real GDP growth, which was also followed in Q3. Another reason for the negative data can be explained by looking deeper at the breakdown of the Q1 GDP growth data. The graph does look a little messy here, but let's only look at the darkest shade of blue as they are the latest revised numbers posted. Looking at the breakdown of the Q1 2025 data, we can see that business investment contributed a large amount, which but was dragged down by a low contribution from exports and consumer spending, along with a big increase in imports, which subtracts from the economy. This increase in domestic investment and relatively flat foreign imports could be explained by the tariffs and trade volatility that occurred after President Trump took office. Now, coming back to Q4, households definitely contributed a significant amount to the GDP growth, but this concentration on consumers could backfire if unemployment continues to increase and the job market takes too long to recover. Looking towards domestic investment, we can see a lot of growth also being seen in this sector, indicating that business activity has picked up in this quarter. And with the current AI boom going on and the data center build out, the overall sector is seeing continued growth as AI boom's effect also transfer on to construction and utilities, etc. etc. Spending was actually dragging down the GDP growth in this quarter, with the government spending contribution down nearly 1% in this quarter. This can be possibly explained by the government shutdown, which was the longest government shutdown in US history. This also potentially transfers over into consumer spending as a government shutdown meant most of the workers were not receiving their salaries. Exports were also slightly down this quarter. They are, of course, on shaky ground as they are cyclical in nature and depend on the overall health of the economy, the trade relations of the country, and the foreign exchange rates. The last contributor to the GDP was the slight negative contribution from imports. Now, as I said, it looks positive on the graph, but when calculated, it is still subtracted from the GDP data, as these goods were again not produced domestically within the country. Looking towards the job market now, as I mentioned, consumer spending is at risk if the job market does not recover soon. As shown in this graph here, job growth in the recent months has been very low, and the increasing unemployment rate also does not indicate a strong job market and poses a very real risk to future GDP growth of the US. Right. Now, after the Q4 GDP data came out, the dollar ended the day slightly up on the Feb 20th, along with the Treasury yields, which also ended slightly higher than they started at, which are essentially these Treasury yields, government bonds, and are a very useful indicator of trust in the government to continue paying its debt obligations. Now, in this case, the higher yields actually mean lower trust in the government, as this data is not entirely positive and coming way below the expected from analysts and from other nations about what the GDP growth looks like, which is why this can be attributed to the higher treasury yields coming at. Now, overall, there is still positive GDP growth happening, and the low growth could be largely attributed to the government shutdown, potentially also, like I said, causing a domino effect in also the consumer spending. The current tariffs and trade volatility are also other factors to consider, especially now with the Supreme Court declaring the tariffs as illegal, but still an extremely weak and fragile job market remains. The situation can become worse very quick, and we will know more about it after the unemployment rate is released later this week on Friday, the 6th of March, and the data could very well be the straw that breaks a camel's back. That's it for this video. Thank you for watching, and I will see you next time.